Okay, welcome to my site, and I'm going to show you the difference between fundamentals and technicals. And it's an amazing thing that these people come on TV and they give you these stocks because Obama is going to become president, that they should do very, very well and you should buy them right away. Now, let's take a look at one of these stocks. This is it right here, and I'm putting this up on my chart. This is my daily chart right here. It's called a daily chart. What is a daily chart? It identifies for you the probability of what the stock's going to do between 2 days and 2 weeks. And you notice on the 4th of November, this is one of the stocks that Cramer recommended. Well, it lost over 30%. Okay. Now, we knew not to buy it. We knew to short it. Why? Well, because the chart told us that the institutions who own this were getting out. How do I know that? Well, I know it from a couple of things. First of all, let's go take a look at the stock itself, ENER, and on a chart, we have certain sell signals. And you see this purple line right here and this white line? These are signals. This white line, these are called moving averages. And I'm not going to get into that, what moving averages are, but I will tell you this. That see, the white one's a 200-day. The purple one is a 25-day. See, and the purple one was crossing over the white one. That in my business as a technician, that tells you that a no-no. You don't buy that. Matter of fact, you make money by shorting it. And then also we had the yellow one, the 50-day was crossing over the 200-day. That's a no-no. So you had two strong signals right there that the institutions that own this are getting out. They're taking their money out. This is when Cramer told you to get in. We also had another sell signal right here. Anytime that you see this red line, these are called stochastics, cross over the white dotted line, that's a sell signal. That means that there's a high probability within 2 days to 2 weeks that the earnings and the revenues of this stock is going to decelerate. And of course, it proved to be true. And that's why it dropped from here all the way down to here. So you lost over 30%. Now, they also classified it as an investment. Well, that was wrong because it's not an investment. Every stock's not an investment. It has to prove itself to be an investment. What does that mean? Well, first of all, this is a different chart here. This is what we call the weekly chart. This chart is our daily chart. This tells us the probability looking out 2 days to 2 weeks, whether the stock's going to have a high probability of increasing, accelerating, or decelerating. This one, on the other hand, looks out further, 2 months to 3 months. This is the mother lode right here. And it showed definitely that this stock was no investment. Let's take a look. You can see since June, this stock, or even August, this stock is not an investment. It means that the stock, when it crossed back over right here, that was a sell signal. It means the way you make money is you sell it short. That it's going down because it had a crossover. And that means that looking out 2 to 3 months, that this stock, going back to August, this stock was going to go negative, and it did, see? And then, of course, if you can see it happen, see out here in August right here? Now watch this. You go look at a shorter time period, okay, over here. You see it? August right here, see it broke? Broke again, rallied, broke again, broke again. So if you take the two charts and you compare them, and you can see from both these charts, and you compare them in time, Let's move this up. Okay. You can see this started to break down. This started to break down right here in June. See that downtrend? All the way to present. And you can see going all the way back in this chart, this is called your daily chart. You see, even though these had rallies, see it? See these upper rallies? That meant every time that it rallied, it was going to fail. You see, every time it rallied and you got in and got excited because it was going up, it was going to fail. See, it rallied and failed. It rallied and failed. It rallied and failed. So inside this time frame right here, okay, of June, okay, to present, you see that smooth line going down? This looks out 2 to 3 months, even longer. This looks out 2 days to 2 weeks. So during that time frame, let's take a look from here all the way over to present, okay, or let's take from August right here, okay, to make it easier for you. August, you see right here, every time it rallied, we knew to stay out of it because it was going down. How do we know? Because you had a smoothing mechanism right here. It kept telling you it was heading down. See that? So we knew every time it rallied, see like it rallied here? We knew here, once that rally was over, to short it. And we made money shorted it. Then she rallied again, you see? And every time she rallied, you knew it was going to fail. You see, every time it rallied, you know it's going to fail. See what charting does? It's a wonderful thing. So again, an investment chart is this one. So this looks way out and tells you, as this was never to be in this stock. But going back to the point, when he told you in this time frame, right here, see it? That's when it told you to get out. Right there, see it? November 4th, right there. See where that line went? November 4th, told you to get out. See it right down here? See that? So that's the beautiful thing about charting. Now, he was probably right, Cramer, on the reason why you should buy it. It may be, and we may buy it, but he took a loss. Now, if you're a gang member, what you would have done is short that. You would have made money on the way down, and now you can make money on the way up. So fundamentals don't tell you when to get in and out. Technicals do. So let's take a look. It's now forming a typical, what we call a W formation pattern, a simple W, all right, which means that you can buy this stock, okay, now it's got these two bottoms here. You wait and you buy it. You can either buy it now and you put a 1-point stop underneath. So you buy it at 28.27, or even say a 4-point stop or a 3-point stop, whatever you want. But put a stop in 28.27. And let's say you put 1 point in. That's what we do. That means you're out at 27.27. You only lose $25. Wait till it starts going your way. What do you want it to do? Well, you want to see this right-hand side go all the way up and meet the middle of the W. If that does that, and it's not interrupted, no, it doesn't go up, come down, up, go down, up, go straight up, that means it's got real strength. And the best place to buy it then, or to add to the position, is when it gets through this moving average right here. Right through that 200-day moving average, this white line right here. Then you buy it. That's called a breakout. The safest place to buy a stock is you wait for this W formation to happen. The right-hand side goes up, meets the middle, and then when it breaks out through the moving averages, as they break out, that's when you buy. Then you got a high probability of going right up to here. All right? So you see, Cramer got you in exactly at the wrong time, and that means you had to lose money on that stock, which doesn't make any sense. You could have traded it and made money by put that money in your pocket, turn around, then go long. So join the gang, and I will tell you, and I will teach you how to read your charts. It's not that difficult. There's a little W formation right there. With that little information, guess what? You would have never lost your money. Let's take one more, and that will be it. Let's take a look at LDK. Same exact thing, see? He said to buy it right there, November 4th. Look what happened. But now it's getting ready to buy. But when do we buy it? We wait. We patient, and then I'll tell you when to buy it. When this red line turns up through this white dotted line, that then tells us that the stock's earnings and revenues for the next 2 days to 2 weeks will be turning positive, high probability. But before you buy, you need one more thing to turn up. That's the S&P. You never buy a stock unless, see this line on the S&P 500, you never buy a stock until that turns and runs back up. Then when they're both turning, both going up, then you have a high probability of not losing money. So always remember that. Why don't you join the gang? Phil's gang. See you on the charts.